Eric, I think the headline here that their profit target remains firmly in the fourth quarter of 2021, which is now a full year later than Uber's self-imposed profit target. That could be what's driving the stock lower. What does Lyft need to do to get to profitability faster?
You know, Uber had the advantage of having its earnings first, got to surprise investors by moving up its profitability target. And I want to be clear, we're talking about, the adjusted profitability here. So cuts out a lot of things. There's still, even stock comp, these companies are spending a ton of money. But yeah, Lyft is still growing impressively. I think it was something like 50%. They got to $1 billion in revenue in the quarter. But they have the disadvantage of being smaller. And Uber's just sort of had more time to become a huge business and then start turning those levers to try and make a profit. Uber, in particular, is focused on business customers, which could help it get to profitability. And so it seems like Lyft just doesn't want to commit to the same timeline of its much larger rival.
Eric, I think you hit it spot on when you said the profitability targets are adjusted EBITDA. It's not even down to net income on the bottom line. Do analysts care that it's supposed to be EBITDA profitability, not even net income profitability? You take out all of those other expenses that are not yet being included.
Yeah, on some level it is shocking to be talking about Uber getting to profitability this year when, if we just look at 2019 losses, I think it was something about above $8 billion on a net income basis because they have something like $4 billion in stock loss and then lots of other expenses. So on a GAAP basis, Uber is a company that loses a ton of money. But the reason we focused on these sort of adjusted EBITDA numbers is they give analysts and investors some way to get their heads around how the company starts to make money. And so, that's sort of the framework that the markets are paying attention to. And so that's what we've been talking about. But yeah, it's certainly important to remember that there have been huge stock expenses and other expenses that are still going to be a problem for these companies.
Eric, as part of the problem here is that the rides market is simply getting saturated. You can't encourage consumers to just start taking more rides. Does Lyft need to start finding new ways to make money?
Yeah, I mean, Lyft has the advantage of growing into sort of a market that's bigger than the company, right? You're still seeing it grow into new active riders, which is a good sign for Lyft. On Uber's call, you heard the executives say over and over again that they were going to face the law of large numbers, that they were just going to run into the sort of top size of the ride-hailing market. And so obviously Uber has gone into food and other industries in a way that Lyft hasn't. And so far Lyft's message has been focused. And I don't think we've seen any sign that they're going to veer from that. For the time being, it seems like they need to show that they can run sort of a profitable ride-hailing business and make it work as the smaller company.
How about on the cost side of things, Eric? Lyft's already said it's going to cut 90 jobs. Is this potentially just the start?
I mean, corporate jobs matter, certainly symbolically, but at the end of the day, what matters here is price competition and how Uber and Lyft are, digging into their prices to gain ground relative to each other. And I think that's why these stocks have traded, have been so related to each other. Investors react to one announcement for the other because there's been a price war going on. And I think Lyft said that Q1 would be sort of peak loss, so that has all these sort of competitive dynamics. But the big question is just, if subsidies come down, what is the total addressable market for ride hailing? And does that limit sort of the number of people who will take a ride?